Everyone thinks the next financial crisis will start with debt. Too many loans, too many credit cards, maybe a housing bubble. But it won't. It will start with promises, invisible promises, written not on paper but in contracts between banks. A web so large it now holds more than $600 trillion. That number is so big it stops meaning anything. 600 trillion is about 6 times the value of everything produced on Earth in a year. It's the sum total of a shadow world called the derivatives market, where banks, hedge funds, and even governments trade bets on the future. Bets on interest rates, currencies, oil prices, even the weather. You've never voted for this market. You don't see it in your bank account. But every mortgage rate, every government bond, every price on your supermarket shelf is quietly tied to it. Because when money stopped being backed by gold, something had to replace trust. And the system found it in mathematics, in models, in derivatives. They were supposed to spread risk. Instead, they multiplied it. They turned $1 of real capital into $100 of virtual exposure, and then called it hedging. When you hear central banks talk about stability, this is what they mean, keeping that web from snapping. Because if just one part of it fails, one major counterparty, one unexpected move in interest rates, the whole system can tremble. We saw a glimpse of it in 2008 when a single firm, AIG, couldn't pay on $440 billion of swaps and nearly brought down the world economy. That was just the edge of the market. Today, the total is 10 times larger. And yet the paradox is this: no one truly knows where the real risk sits. These contracts don't live on public exchanges like stocks. They live in private agreements, over the counter, hidden from sight. The regulators can measure them, but they can't map them. Imagine a city where every building is wired to every other with live electrical cables, but no one has the blueprint. That's the global financial system in 2025. So when you hear $600 trillion, don't think of money waiting to be spent. Think of it as a pile of promises waiting to be tested. Each one assumes the other will hold. The danger isn't that all of it collapses at once. It's that a single spark could reveal how little of it was ever real. Arithmetic doesn't panic, but it never forgives. The numbers have already outgrown the world that created them. It didn't begin as a monster. It began as an idea, elegant, technical, and harmless looking. The year was 1971. Nixon closed the gold window, and for the first time in modern history, money floated freely, detached from metal, backed only by promises and central banks' credibility. The world needed a new way to manage uncertainty, because once gold disappeared, currencies began to dance. The dollar could rise or fall overnight, oil prices swung wildly, and interest rates, once fixed by governments, started moving like tides. Businesses couldn't plan, banks couldn't price risk. Then in 1973, 2 economists from the University of Chicago, Fisher Black and Myron Scholes, published a paper. It wasn't political, it was mathematical. They described a formula to price options, contracts that let you bet on the future value of assets. Robert Merton refined it. Wall Street fell in love with it. By the 1980s, financial markets had a new religion. You can turn risk into a product. Instead of fearing volatility, you could sell it. Instead of losing money on fluctuations, you could hedge, or better yet, profit from them. This was the birth of the derivatives era. A few traders in London and New York began experimenting with interest rate swaps, simple agreements to exchange fixed interest payments for floating ones. It seemed harmless. But in those deals lay a new logic. You could manufacture stability out of thin air as long as everyone trusted the math. The first big one happened in 1981 between IBM and the World Bank. The World Bank needed dollars, IBM wanted Swiss francs. They didn't exchange money, they exchanged promises to pay each other in different currencies, and it worked. Soon, every major bank realized it could do the same, not just to hedge, but to create positions without moving actual capital. By the mid-1990s, JP Morgan built the next level, credit default swaps. In simple words, insurance on debt. If a company defaulted, you get paid, but unlike real insurance, you didn't have to own the asset to insure it. It was like buying fire insurance on your neighbor's house. The moral hazard was baked in from day one. The regulators? They didn't stop it. They blessed it. In 2000, the U.S. Congress passed the Commodity Futures Modernization Act, signed by Bill Clinton. It officially allowed over-the-counter derivatives to stay unregulated. No oversight, no central clearing, no reserve requirements. Why? Because these products made debt look safe, and governments needed that illusion. When you can hedge everything, you can borrow infinitely. The old limit, gold, was gone. The new limit was imagination. London became the empire's offshore hub. Wall Street provided the brains. The BIS in Basel quietly watched. And the same logic that once built colonial trade routes now built digital ones. Invisible flows of credit, risk, and leverage circling the planet. What the British East India Company did with spices and silver, modern banks did with interest and derivatives. They privatized profit and socialized loss, backed not by fleets, but by spreadsheets. By the early 2000s, the system was self-reinforcing. Each new contract created a mirror image of stability. Each hedge became collateral for another. Derivatives weren't attached to reality anymore. They defined it. And behind every equation stood a simple old truth. Those who control the risk control the world. Because when governments fear collapse, they rescue the risk makers first, not the people. The $600 trillion machine wasn't built overnight. It was assembled, piece by piece, by mathematicians, lawyers, and central bankers who thought they were taming uncertainty, when in fact they were industrializing it. For almost 3 decades it looked perfect. The models worked, the graphs went up. Economists declared the end of the business cycle, a great moderation, they called it. But moderation for whom? For those who printed the contracts. From the mid-1990s to 2007, the world lived in a financial dream. Banks no longer made money by lending. They made money by slicing loans into pieces and selling the slices as derivatives. Mortgage bonds, collateralized debt obligations, swaps on top of swaps. If it moved, you could trade it. Every new derivative seemed to reduce risk because it spread it. But spreading risk is not the same as eliminating it. It's just hiding it across thousands of balance sheets. It's like turning a pile of garbage into a million tiny sparkles of glitter. Looks clean until you breathe it in. At the heart of the illusion was leverage. A bank with $1 could control 20, 50, even 100. Why not? Every position was hedged. Computer models said the odds of total collapse were lower than a meteor strike. They forgot. Meteors do hit Earth. The Federal Reserve and the European Central Bank applauded. Stability looked like success. Credit expanded, asset prices soared, and ordinary people, the ones watching this video, were drawn into the party. Your house became an investment, your pension a derivative fund, your country's debt a trading instrument. The rich got richer not by owning things, but by owning risk. If you controlled the swaps and futures, you could decide the price of everything else. It was a quiet empire of code, and its colonies were every household with a loan. Think of 17th century Amsterdam. Ships sailed out with spices and came back with gold, and for a while it felt infinite. Then one ship didn't return, and the whole balance trembled. The same happened here, except the ships were credit default swaps, sailing through digital oceans. By 2006, J.P. Morgan, Deutsche Bank, Citigroup, Goldman Sachs, all of them, sat on mountains of exposure. The total notional value of derivatives worldwide passed $500 trillion. That's not a typo. It was the largest number ever written in human commerce. But the system's faith was religious. As long as prices went up, everyone was a genius. Ratings agencies stamped junk as AAA. Regulators spoke of financial innovation. And when someone, a trader, a journalist, a politician, asked if anyone truly understood the scale of these contracts, the answer was always the same. Don't worry, the models are safe. It was the same tone the French used about their assignats in 1792, paper money backed by confiscated land. As long as confidence lasted, paper was wealth. Then confidence cracked and paper became dust. The 2000s were our modern assignat era. We called it structured finance. We worshipped the formula instead of gold. And as with all empires built on faith, the more it grew, the more fragile it became. Arithmetic doesn't care about belief. For every winner in a derivative, there must be a loser. The bigger the system, the smaller the margin for error. All it needed was a tremor, a missed payment, a dip in housing prices, and the illusion would unravel faster than anyone could model. The golden age of paper wealth wasn't real gold. It was trust, leveraged 100 times. If this helped you see how prosperity can be engineered and why it never lasts, leave a comment where you're watching from. It started, as collapses always do, with something small, a number that didn't fit. In 2007, a few U.S. homeowners stopped paying their mortgages. Nothing unusual, the bank said. Out of millions of loans, what's a few defaults? But those few were the base layer of a pyramid built on derivatives. Each unpaid mortgage sent a tremor upward through thousands of contracts valued in billions. Then came 2008. The models that once predicted zero chance of systemic failure suddenly stopped working. The spreads widened, liquidity vanished, and the great fiction of diversification turned into a single, synchronized panic. The name that lit the fuse was Lehman Brothers, 158 years old, trusted by governments, counterpart to half of Wall Street. When it failed in September 2008, it wasn't just a bankruptcy, it was a detonation. Lehman's derivatives, swaps, futures, and options with over 900,000 counterparties, froze instantly. Each one had been hedged with another bank, and that bank with another, in a chain no one could trace. The formulas broke first, then the politics. Because every derivative is both an asset and a liability. Once the prices moved outside the range of the models, no one knew what anything was worth. AIG, the world's biggest insurer, was supposed to backstop it all. $440 billion in credit default swaps. Overnight, its insurance became a black hole. To stop the collapse, the U.S. government stepped in with $182 billion in emergency funds. But it wasn't to save homeowners. It was to pay AIG's counterparties, Goldman Sachs, Deutsche Bank, Societe Generale, the very architects of the system. The moral was simple, brutal, and timeless. When the bets go bad, the house always gets rescued. That's when the illusion shattered. People saw that the system wasn't about markets, it was about maintaining belief. Trillions in wealth vanished. Pension funds, small banks, governments, all caught in a network no one could unwind. And yet the derivatives themselves didn't disappear. They were too integral. Central banks slashed rates to zero, printed money, and quietly absorbed the damage. They promised it was a one-time rescue. But the math didn't reset. It just moved higher. By 2010, total derivatives exposure climbed again to $700 trillion. The same machine, patched and repainted, began to hum once more. The European debt crisis, fueled by swaps. The Asian currency turmoil, triggered by hedges gone wrong. The tools that broke the world were now being used to stabilize it. What we saw was the moment when mathematics proved stronger than democracy. Politicians could debate budgets and social programs, but a single line in a derivative contract could move more money than all their decisions combined. It was the same logic that ended every empire before it. Rome tried to freeze prices. The British tried to peg silver to paper. The French tried to regulate the assignat. None could fight arithmetic. When numbers break faith, governments kneel before the banks that hold them. 2008 wasn't just a crisis. It was the moment the illusion of control ended. The machine revealed itself, unregulated, unvoted, untouchable. And yet, instead of dismantling it, the world decided to trust it again. If this helped you see that crashes aren't accidents but consequences, say where you're watching from. If you're hearing this in 2025, know this. The system didn't end in 2008. It mutated. The same web of derivatives that once nearly collapsed the world was quietly rebuilt, thicker, more automated, and far harder to see. Central banks became its lifeline. After 2008, the Federal Reserve, the ECB, and the Bank of Japan slashed interest rates to near zero and flooded markets with liquidity. That flood didn't go into factories or wages. It went into assets, Stocks, bonds, property, crypto, everything inflated. And to hedge those bubbles, banks created new generations of derivatives. Interest rate swaps multiplied. Currency swaps ballooned. The market for notional derivatives, the total face value of all these contracts, once again climbed past $600 trillion. The difference is, this time the system depends on them entirely. Governments can't finance their debts without swaps to fix interest rates. Corporations can't borrow without hedging. Even central banks use derivatives to manage reserves. It's not a parallel system anymore. It is the system. That's why, when rates started rising again in 2022, the machine began to shake. In Britain, pension funds used liability-driven investment strategies, a polite name for highly leveraged derivatives. When bond yields spiked, their positions imploded. The Bank of England had to intervene, not for banks, but for pensions. In the US, regional banks like Silicon Valley Bank collapsed because their safe bond portfolios lost value, and the swaps meant to hedge them didn't keep up. Every crisis since 2008 has been a derivative echo. When you hear about liquidity injections, repo operations, or quantitative easing, understand, those are not abstract tools. They are emergency pumps keeping the derivative machine from seizing. The world learned the wrong lesson from 2008. It decided the problem was confidence, not structure. So instead of dismantling the tower, we built scaffolding around it. Regulations that made it taller, algorithms that made it faster, and central banks that guaranteed it would never be allowed to fall. But you can't ensure infinity. A single interest rate shock, a war, a default, a data error, can send a wave through $600 trillion in contracts. That's why governments panic at the hint of instability, not because they fear inflation or unemployment, but because one wrong move in derivatives could freeze the entire financial bloodstream overnight. Remember, these contracts don't vanish when markets calm. They just roll over, compounding. Every hedge becomes the seed of the next exposure. We are living inside a financial perpetual motion machine, one that needs ever larger inputs of credit to avoid implosion. It's the same logic that fueled every empire before collapse. Rome diluted silver, France printed assignats, we issue derivatives, promises on top of promises. Each era believes its mechanism is too complex to fail. Each ends the same way. When trust runs out, arithmetic takes over. So the time bomb ticks quietly, hidden in balance sheets and footnotes, disguised as risk management. But risk doesn't disappear, it waits. If this opened your eyes to how the illusion still rules our daily economy, leave a comment and tell me where you're watching from. Every empire has its monument. Rome left marble. Britain left railways. Ours will leave debt contracts, invisible, endless, and self-replicating. The $600 trillion system isn't just financial, it's psychological. It's built on the belief that risk can be priced, that the future can be traded, that math can outsmart human greed. We don't use gold anymore, we use models. We don't trust reality, we trust volatility curves. But there's an ancient rule money never forgets. If you promise more than you can deliver, someone pays, eventually. For centuries, societies tried to hide that truth behind miracles of paper, assignats in revolutionary France, tulip contracts in 17th century Holland, mortgage derivatives in 2008. The shape changes, the arithmetic doesn't. Look at the world today. Nations borrow not to build, but to refinance. Corporations buy back their own stock with leveraged debt. Central banks intervene daily, not to guide economies, but to keep derivatives stable. We've reached a stage where finance no longer serves life. Life serves finance. That's why the time bomb keeps ticking. Because the numbers aren't evil, they're indifferent. They don't care about promises, ideology, or hope. They just demand settlement. And that settlement, when it comes, will not be declared by politicians or traders. It will come quietly, through collapsing yield curves, frozen liquidity, and panic in screens, the sound of arithmetic collecting its due. So the real question isn't if the system collapses, It's how much truth we can face before it does. Whether we build something anchored in production, work, and trust again, or whether we keep worshiping derivatives until the faith runs out. The time bomb isn't under Wall Street. It's under our belief that infinite promises can live in a finite world. If you felt that, share this video and tell me where you're watching from. Because every collapse begins with silence and ends when people finally start to see.